The nightmare scenario is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, we've been warning you this was going to happen, and now the worst case scenario has started. And what I want you to see is why this means the financial system is on the verge of an outright collapse. Plus, we have a sponsor for today's show who's forging the future in gold, and they just had a major announcement this morning that you're not going to want to miss. And plus, we're going to show you how we think you can trade their stock for a 38% move to the upside. Stay tuned to the end of the show or check out the description or pinned comment for more information. Now, if you're wondering what we're doing in China, that will make more sense in a little bit, because first, I want to take you a step back before we see just how bad this scenario is, because not long ago, everyone said everything was fine. But now, in a moment's notice, I want you to see how this was lurking underneath the bed the whole time, and now the nightmare, well, it's here. Credit risk gauge declines most in 2 weeks as inflation cools. This from Bloomberg. Look at this. The decline in the cost of credit protection is a signal that global growth is stabilizing. But I think it's the softening of U.S. inflation picture that credit markets are most strongly reacting toward. The case for a soft landing keeps increasing. And so what we see here is that everyone suddenly thought, hey, the banking system looks okay because look, credit spreads are coming down. Everything says the economy is indeed turning, and it kept multiplying on top of that. Even money managers jumped in as high-risk loans return, as recession risks fade. And everyone says, look, I got to buy now and in a big way. Because as the risk of a severe recession lessens, while the supply of new debt has stayed relatively low, money managers were on the hunt for opportunity to put dollars to work, and that's pushed the secondary leverage loan prices near highs not seen in months, as investors who are flush with cash are seeking out supply, leaving borrowers to stream into both junk and loan bond markets with opportunistic deals in recent weeks. And again, these are all signs that the system is getting better and that it's healing. But underneath the covers, this was a big sigh of relief for the banks, because they've been sitting on these garbage loans that they're desperate to unload. As we talked about in the show yesterday, the banks know what's coming. They need to get rid of this. And sure enough, investors were eager to take it from them. Here you can see in Europe, banks have also been dealing with billions in what's called hung debt. This is loans that the banks originate and then can't sell, much of which they managed to rid themselves by the end of the second quarter, albeit at huge losses. And we're starting to see that here in the U.S. as banks are just so happy that investors just want to take this off their book. They're just dumping it because they know that the nightmare scenario is starting, and it's got some dire consequences, as you'll see in a bit. And then all of a sudden today, the narrative changed. U.S. bank shares drop as Moody's cuts ratings, warns on risk. Now, if indeed the global economy was turning around and the banking system was healing, there would be absolutely no reason to cut the ratings of these banks. And sure enough, they did. Higher funding costs, potential regulatory capital weakness, and rising risk tied to commercial real estate are among strains prompting the review. Collectively, these three developments have lowered the credit profile for a number of U.S. banks, though not all banks equally, the rating company said. And this is a big problem for the banks. They've already taken a big hit. They've watched capital outflow happen. They've watched their stocks drop. They've watched depositors leave. I mean, it's just a problem. And due to tighter lending conditions, they can't go out and originate a bunch of high-interest loans to at least try to keep depositors around. And now all of a sudden, Moody's steps in and says, you know what? We're giving you a downgrade on top of that. Good luck trying to survive. And rising funding costs or declining income metrics will erode profitability. Asset risk is rising, in particular for small and mid-sized banks, as we've been saying and warning, with large commercial real estate exposure. But that's not the whole story here. In fact, this is just, you see this transition from everything okay to all of a sudden things are starting to look grim. And that's not even where we're getting to with our main story, because when you see just exactly what this worst case scenario is, it's even worse news for the banks. Some banks have curbed loan growth, which we've talked about, no surprise, which preserves capital, but also slows the shift in their loan mix towards higher yielding assets. So this is a problem because the banks at this point could go out and buy treasuries, but they really need to be originating new loans because those they can charge more interest, they can make money off the spread and still pay depositors. Now they're facing a problem is they can't get these bigger value loans. They've got to turn to lower yielding assets. It's a huge mess for the banks. And here we can now see this is the big shift. This is indeed the nightmare scenario that's coming as consumers finally crack. Shocking drop in June credit card debt marks the end of the spending binge. Now, we've been warning about this because in a debt-based system, it's absolutely critical that new money is continuously originated. And now that comes from commercial industrial banks offering new loans. And that's how new money is created in the system. Now, the problem starts to happen when consumers either tap out their limits and banks won't allow them to have more credit, or they see that interest rates are so high, the economy is slowing, and they start to say, wait a minute, maybe I need to pay down my debt. And that's when the whole system starts to come to an end. And that's what I was talking about in the beginning of the show, is why the system's on the verge of collapse, because when credit starts to reverse, bad things happen. Here we can see, as Zero Hedge said, they were right. They just had to wait 1 month because following the Fed's release of consumer credit, they had another shocker, this time on the other side of the credit spectrum, because while non-revolving credit, now non-revolving, think of this as like student loans, car loans, things that have usually a fixed rate and a term that goes with them, well, that isn't a big deal. That did jump by a whopping $18.5 billion, which I'll show you why in the next slide isn't a big deal at all, up from last month's drop. But that's not the story here, because this will promptly reverse when student loan repayment moratorium ends on September 1st and people are looking for money. But here you can see non-revolving consumer debt typically actually is not even impacted often by recessions. There's sometimes, as you see during the global financial crisis, it slows a bit, but it's really not a big deal. You see it slowing here a little bit, but again, it's not a major issue. The problem is it's the revolving debt or credit card debt, and that was a jaw dropper this month, Zero had said. Because after several months of solid increases, including a near record $14.8 billion in April, get this, June credit card debt actually dropped by $0.6 billion, the first negative print since April of 2021. And what this means is now debt is going the other direction. This means more people are paying off their debt than are borrowing debt. And in a debt-based economy, that starts to be the worst case scenario, because instead of a constant creation of new debt, now you have people fighting over what money is left, because as loans are paid off, money gets destroyed from the financial system, and that's not good news for the banks, the economy, or anything. And here we can see, as Zero Hedge notes, as Americans actively paid down their debt, something they only do, get this, as you're about to see, when a recession looms. And sure enough, that is verified in this chart as the revolving consumer credit owned and securitized. You'll notice that going into recessions, what do you see? Consumers start to pay down their credit cards, and that is a definite sign we're heading into a slowdown. You see that here in 2015-2016, but at this rate, we're headed into an outright recession, and that's what means the financial system, as I've explained before, is on the verge of all-out collapse, because once credit reverses, it's really hard to stop it. So what we're seeing now is the Fed's effect of higher interest rates is really digging into the system now. It means borrowers no longer want to pay higher rates. They want to pay off that debt, and that's terrible news, not just for the financial system, but you start to think about retailers and wholesalers, manufacturers. Well, it all comes full circle. Here you can see revolving consumer credit against the general business activity for the Philly Fed. That is shown in red. And what we can note is when consumers start spending less and focus on paying down their debt, well, what happens to manufacturers' new orders? Well, they go down, and that means general activity, as you see in red, is falling. Now, many people have said this is the bottom here. This is a rebound. And if this is the beginning of consumers starting to deleverage, no, it's going to get a whole lot worse worse for the factory sector, and you already know what that means is more layoffs. And sure enough, that's validated as we now overlay the 4-week moving average of initial claims that's shown in red over the revolving consumer credit. And again, as consumers spend less money, well, you don't need as many people manufacturing goods. You don't need as many people transporting them. You don't need the warehouse people. You don't need the retail office space. You don't need anything because no one's buying. And sure enough, here you can see the 4-week moving average then heads up during every slowdown in credit. And everyone's now saying that, hey, this is a reversal here. This is coming down because the economy is robust. Well, if this indication from the Fed's report of what consumers are doing is correct and the beginning of a trend in contraction, well, it means that more people are going to be out of work soon, thus validating this nightmare scenario. And what all this means for interest rates, and this is something a lot of people struggle with understanding, is the Fed has artificially pushed rates higher, and that is causing a contraction or the beginning of a contraction in credit. So what happens in the monetary system that needs and desperately needs new money to be created, it sees this artificial force against it, and then next thing you know, rates start to come down because if higher rates and tighter financial conditions do not spur people to borrow, then the system has to lower rates rapidly or else the whole thing starts to implode, and that puts the system on the verge of collapse. And as you're about to see, yields collapse as well. And here you can see revolving consumer credit still in blue, now against 10-year Treasury yields. And you can see when consumers start to deleverage and stop actually wanting to take on new credit, yields start to fall, and in a big way. You can see that here again during the global financial crisis. They just outright dropped as consumers shunned borrowing money to pay it off. You can see here again during the global slowdown in 2015, 2016 that almost led to a recession. And now investors and money managers and hedge funds, they all think rates must go up and a lot higher. That's why I put a question mark up there, because what we're seeing in the consumer credit market says yields aren't just coming down, they're coming down in a big way. And here's the validation of that, because when consumers spend less, well, there's a reason why we're in China today at the ports, because we wanted to see firsthand that is this slowdown being validated, because if you want a validation in the global economy, there's one place to look, and that's the global trade sector. And now, based on the data we got last night from China, it doesn't look good. China reports double-digit plunge in July exports and imports, missing expectations as people were hopeful the global economy was turning around. As China's exports to the U.S. plunged by a whopping 23.1% year over year in July, while those to the European Union fell by 20.6%. So if you're hoping the European Union was turning around, this data says not a chance. Exports to the Association of Southeast Asian Nations fell by 21.4%. Their imports from Russia fell by 8.1%, suggesting that their domestic economy isn't doing good. And get this, a slowdown in the U.S. and other major economies' growth has dragged down Chinese exports this year. Meanwhile, China's domestic demand has remained lackluster and is likely to get worse, because if all of this external demand is going away, well, what do you need less of in China as well? Well, you need don't need as many workers in factories. And all of this now, you start to see it coming full circle, that there is no second half rebound, that the worst case scenario is about to hit. And here you can see revolving consumer credit overlaid by the import price indexes from all industries for China, suggesting, just as we've been saying, as demand goes down, clearly the credit markets are suggesting that prices are too going to fall, which is the case that many don't believe that the consumer price index is not only going down, which we should find out more tomorrow, but potentially headed into a deflationary scenario, because we're at the inception of this credit slowdown. And if this is validated by the China Price Import Index, well, it tells us everything we need to know. And now on top of that, the U.S. trade deficit narrows as imports decline to the lowest since 2021. The shortfall in goods and services trade narrowed by $2.8 billion to a 3-month low of $65.5 billion. And notably, even though these aren't adjusted for inflation, the value of total imports declined 1% to the lowest level since November 2021, reflecting decreases in the value of capital goods and industrial supplies. Notably, that's called disinflation. So here we're seeing this happen not just in China, but it's all eventually getting to the US, because again, what we're seeing is consumers starting to retrench, deleverage, and that means less spending, less employees, and almost a surefire explanation of why the nightmare scenario is going to annihilate the banks. Imports have largely been decreasing since peaking early last year. No surprise, because there's a lot of pandemic money still floating around, as shifts in consumer spending translate into lower demand. So notably, they're passing this off as, hey, it's just a translation of people moving to services. Here you see the lower demand for foreign-made products, as Americans have steered more of their purchases towards services from goods, and some are also growing more discerning about their spending. What you're going to see next is everyone be shocked that the services spending side, well, that's coming down as well. And here we can see on this next chart where imports go, well, that's only because Americans are indeed deleveraging and spending less. As revolving consumer credit owned and securitized still in blue against imports of goods and services. And what you can see here as imports go down, well, sure enough, that's validating that consumers are indeed spending less, wanting less goods and services. And sure enough, you see that happening now, suggesting that consumer credit is headed even lower. That means more unemployment, because there's just isn't the need for workers. And that then, my friends, is creating the nightmare scenario. But where we think the future is, well, right now, that's with our sponsor, who's forging the future in gold, and like you to introduce you to Northern Superior Resources. Here you can find them on their website. We'll put all of that in the description, pinned comment, everywhere you need to look, you'll find that. They're trading on the OTCQB under NSUPF and on the TXSV under SUP. We're going to show you in a little bit how you can trade this stock at what we think is a 38+% gain to the upside, because they just had some major news. But let me introduce you to what this company is doing. They're a gold exploration company in Quebec and Ontario who is consolidating the Chibougamau gold pack in Quebec and unlocking district-scale exploration potential in Ontario. And this is a big deal, because when you can bring two areas together, you can really use your equipment to the max. You can get the synergies out of it and bring your costs down and maximize what this major find they just had is. You're going to absolutely love this. But let's take a first look at their chart setup, because I want you to see at one point they traded as low as 2 cents a share and then went all the way up to $1.26. Now, we're not suggesting that this can happen in the near term, but it's possible. I want to show you the breakout scenario, because what's happened is the stock has come down and has gotten into this range here. And this is really important from a trading perspective, because what you're looking for is a supply zone where buyers are at and a zone above where sellers are at. And as long as you can trade in between the zones, you can definitely make some profit here. And if it breaks out to the upside above and beyond that, which we think this claim could have the potential for them to do, well, then the upside is a whole bunch. Let's continue on, because they're leading the consolidation of the Chibougamau gold camp, and by consolidating the most relevant gold deposits in the camp under one roof, Northern Superior is increasing the viability of the resources. The deposits are located within a small radius, which will eventually allow them to be combined into a single operational design, feeding a single mill. And they're looking at this camp as one giant project. And again, you can find them on the OTCQB under NSUPF and on the TXSV under SUP. The exploration in Chibougamau is really phenomenal. Following its long history of copper-driven exploration, it has become evident that the southern Chibougamau camp has been largely overlooked for gold mineralization, and this is why we believe several major gold deposits and important discoveries are inherent in this area. Their properties are even near or adjacent to this Nelligan area, which was a discovery of the year in 2019, and meaning Northern Superior is hoping they could be the next big discovery. And Quebec is one of the most sought after jurisdictions in the world with unmatched government support. And one thing that has a whole bunch of support is their stock price sitting right here around 25 to 29 cents a share. Now you can see these purple bands I put in down here below. This is a supply zone where buyers are at. Above you can see around 40 cents is where sellers are at. And this is a beautiful setup here because we've seen price come down, hold support, and bounce up. It's coming down again, holding support. So what that means is as the sellers are worked out and the buyers take over, your 38% move is from the current price all the way up into the sell zone up here. If it breaks out there, well, sky's the limit. Now let's take a look at their insider ownership. They're owned by about 30% of the shares are held by insiders. And I spoke with the CEO myself, and he said, look, none of us are looking to sell. We think we've got something big here. And that was before this big announcement that just came out. I wait until you see this. Northern Superior announced today, this morning, that they actually now have the mineral project here that is a mineral resource estimate and prepared for their region that was called the Filbert project. And look at this, 48.46 million tons of inferred mineral resources. This is looking to be about 1.708 million ounces of gold. That's huge. They've also found 7.88 million tons of indicated mineral resources, looking to be 278, almost 279,000 ounces of gold. And so they're looking to make a move here and start to get further exploration on this. And that is what we think could be the catalyst to send their stock a whole lot higher, because when this comes to fruition, well, you're going to see their stock is way undervalued. And let's dig deeper here, because we now have the volume profile sitting here at 30 cents a share, indicating, as we've suggested, buyers are all down here below, putting this in a move that once those sellers are flushed out, a potential 38% move back up. Because when you look at the prior slides, you see moves between supply zones go very, very quickly. And we think this quick move for Northern Superior is coming soon. And be sure to check them out. Again, you can find them on the TXXV under symbol SUP, on the OTCQB under NSUPF. And just as always, with any sponsor we feature on our show, you're under absolutely no obligation to purchase their stock. Before purchasing any shares, be sure to do your own research. And again, we've linked all of that in the description and pinned comment for you. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.